If you handed a machine a legendary trader's entire playbook, could it pick the trades? At Ground Truth, we take a money strategy somebody is selling you, and we test whether it actually works on real data. Today, the playbook belongs to Lance Breitstein, a retired prop desk trader. He traded his firm's own money, not clients. By his own account, he made more than $100 million. And he wrote all of it down. A course called Magnum Opus, 121 videos, 13 PDFs. We mined 115 of those videos into more than 1,000 individual rules, each one traceable to the line that said it. We bought it with our own money. No gift, no discount, no affiliate link, which is why nothing in this video needed anybody's permission. Then we handed all of it to an AI and gave it 93 decisions to make. And partway through, we caught something we were not looking for. We showed the machine a chart with the company's name blacked out, and it named the company anyway. Here is why that matters. If it can tell which stock it is looking at, it might not be judging the setup in front of it. It might be remembering what that stock did next, and remembering only works on a chart it has already seen. 3 questions. Keep them, because this episode answers them in order. Question 1. Hand a machine a Legends playbook. Can it pick the trades? Question 2. Does a year of AI progress change the answer? Question 3. When an AI reads a chart, is it reasoning or is it remembering? Quick note, this is education and entertainment, not advice. We test ideas, we do not tell you what to do with your money. This is the audit of a machine that was handed a master's playbook. This is Ground Truth. Here is the pitch, and it is a good one, which is the part people forget. Every trading course on earth sells you rules. Rules are text. Machines are extremely good at text. So if a great trader writes down what he does, properly, exhaustively, with the reasoning attached, then the hard part is finished. You do not need talent anymore. You need a copy of the notes and something that reads faster than you do. Feed that to a modern AI, and you have bottled a career. And to be clear, that last leap is the internet's, not his. He never claimed a machine could do this. We took that pitch seriously enough to spend 3 months on it, and I want to be precise about who is being tested. Lance Breitstein is the expert witness here, not the defendant. We grant his record at face value from his own statements. That record is not ours to audit, and we did not try. We tested one thing only, whether his stated doctrine, handed to a machine, can pick. And that narrowness is deliberate, because can a machine do what he does is not one question, it is a stack of them. Can the written rules be coded? Can a bot trade them? Can a machine read a chart the way he reads one? Each of those fails differently, and if you test them all at once and it loses money, you have learned nothing about why. So we have been going through that stack one layer at a time. This episode is one layer, the one where the machine is handed the doctrine and asked to make the call itself. When it fails, we want to know that it failed here. And be precise about what handing it over means, because that is the whole experiment. His rules are not equations, they are judgment, written in words. Has it capitulated? Is the move orderly? Is the read wishy-washy? We turned 1,000 of those lines into one set of instructions and handed the machine what a chart is made of. 15 days of highs, lows, closes, and volume, and the gap it opened on. No name, no date. Nothing that could tell it which company it was looking at. Everything here is a short. You borrow shares you do not own, sell them, and hope to buy them back cheaper. You make money when the stock falls, and when it rises instead, your losses have no ceiling. His doctrine is about fading euphoria, betting against a crowd that has gone giddy. A stock has run up hard, then it gaps up again. It opens far above where it closed the night before. And before you are allowed to short it, his rules ask 3 questions. Has it capitulated? Capitulation means the selling has actually broken, the last holders giving up, and it has to show in price and in volume together, never just one of them. Is this a steady, orderly climb? You never fade one of those. Or is it violent and exhausted? That one you might fade. And if the read is wishy-washy, the answer is no trade at all. Hold on to that 3rd rule. It comes back. So we set an exam. 93 real setups, in real microcaps, companies small enough that their prices swing violently. And we priced in real friction, which is every cost that eats a trade before you ever see a profit. We charged an 8% a year borrow fee, switched on the rule that throttles shorting after a stock falls hard, and took slippage against us on every fill. The receipts are on screen. On each setup, the machine answers one question. short this, or skip it. And before the first paper was marked, we pre-registered. We wrote down in advance exactly what passing would mean and sealed it so that we could not move the goalposts after seeing the score. Test 1. Does its picking beat a random selection of the same size, not the average one, the lucky one? Test 2. Does choosing beat not choosing? That is, does it do better than a machine that simply shorts every setup it is shown? Test 3. Does it beat a drifting market? 20 positions of the same shape, held over paths with no edge in them at all? The wager was locked before the machine saw a single chart. That matters later in a way I did not expect when we wrote it. And here is the first thing that happened. Before we scored a single trade, it refused 3 out of every 4 setups it was shown. Generation 1 shorted 24 of the 93 and skipped the other 69. Test 1 beat the lucky random draw. That one failed. Test 2 does choosing beat not choosing. That one passed. Test 3 beat a drifting market. That one failed. 1 out of 3. And the one that passed is the one nobody expects, so I want to sit on it. But hold on to that second result, because it is the one thing here that passes twice, and it has earned a name: the veto. The machine's refusals were worth money. The setups it walked away from would have lost. Now remember that third rule of his: if the read is wishy-washy, do not trade. That rule is written down. It was in the pile we handed over. So this is not a machine inventing restraint. It is a machine applying a written rule that a bot cannot apply, because a bot needs a number to refuse on, and wishy-washy is not a number. That gap is where the machine stood. That was the good news, and it is the last of it for a while. The instrument was built for exactly one thing: to be run again. We version locked the universe, the friction, the control tests, the exact words we sent, and even the coin flips, so that the only thing anyone is allowed to change is the model itself. A year later, a new generation shipped. We changed one line and ran the identical exam again. And look at it go. The trades it picked made 67% more than the old model's trades did. Its refusals avoided 2.5 times as much loss. That is a machine that learned. Both of those are true. And in the same breath, the number that prices the whole book went down 9.2%. Those two numbers are about different things, so here's the difference. The first counts only the trades it chose to take. The second prices the whole book. Every position it opened, with the stop applied, the automatic exit that closes a trade once it has moved against you far enough. Plus 67% is the number that flatters. Minus 9.2% is the number that counts. The new model also refused more, 78%, so 20 shorts out of the 93 instead of 24. Every 20 from here on is the new model's. And the exam result did not move. Same 3 tests, same 1 pass, same 2 failures in the same places. So that is question 1, answered provisionally. Hand a machine a Legends playbook and, in our hands, its picking does not clear the bar. And question 2, answered provisionally. No, a year of progress moved the numbers that flatter and left the verdict exactly where it was. I keep saying provisionally, because there is one way a result like this can be wrong, and at this point we had not checked for it. But first, test 1, the one it kept failing. Because the failure is not as damning as it sounds, and the reason cuts against us. Here is the fairest test we know how to build. We take the number of trades the new model chose, 20, and we pick 20 at random instead. Then we do that 2,000 times. That is a Monte Carlo, 2,000 parallel universes where the picks were made by a coin instead of by the doctrine. It does not give us an opinion about luck. It gives us a picture of it. And the machine beat the average coin flip universe many times over. $9,500 against an average of under $500. But the average is not the bar, and test 1 never asked about the average. Some of those 2,000 coin flip universes got lucky, and the luckiest one in 20 made $16,000. That is the bar the machine had to clear, and it did not. One honesty about that, and it cuts against the strength of our own conclusion. 20 trades is a small number. On 20 microcap shorts, a random draw sets a very wide bar, because microcaps are violent. That is a power problem. Too few trades for any test to tell a real edge from a lucky one. So the honest sentence is not that the machine has no skill. It is this: at this sample size, we could not tell its picking apart from a coin's. And that, more than anything, is the reason this episode has a third act. because partway through writing this up, we asked a question we had not seen anyone ask. You have seen the videos. Titles like, I gave an AI $30,000 to trade, or I let a chatbot pick my portfolio. We watched a stack of them, and we could not find one that ran the check I'm about to describe. Was the student reasoning, or had the student already seen the paper? The open book problem. These models are trained on the internet, and the internet contains what every stock did next. So, when you show an AI a chart of a famous company and it tells you the stock goes up, you have not learned that it can read charts. You may have learned that it can recognize the company. Which is why, before any of this, we had already stripped the charts. We took off the ticker and the dates and rebased every price to start at 100, so the level gives nothing away either. We used 12 companies. 9 were famous, chosen to be as recognizable as we could make them. 3 were ordinary, and they were the controls. Then we asked a fresh model, which had never seen our test, to name them. 1 out of 9 on the famous ones, 0 out of 3 on the controls. And the one it named is the data point the rest of this rests on, so I'm going to say it 3 ways. Call it Chart 7. It named the company correctly, and it got that company's future wrong. It recognized the face, and it did not remember the ending. That is identity without memory. Which is exactly what a clean instrument looks like. So we wrote that down, and we moved on. Except a chart on its own is not how anyone picks a stock. A real selection uses context, so we built the most innocent-looking context pack we could justify, and there were 4 facts in it. Fact 1. The sector the company trades in, technology, energy, and so on. 2. A ranking of its last 6 months of return against everything else, on a scale of 1 to 10. 3. A revenue growth band deliberately wide enough to say only grew a lot or grew a little. And 4. Whether the market that quarter was calm, frightened, or neither. And notice what is not in there. No names, no dates, no dollar figures. Before I tell you what happened, look at those 4 facts and work out which one of them could possibly name a company. Everyone is shared by hundreds. Pause if you like. Identification tripled. 3 out of the 9 famous names, up from 1. And Chart 7 came back. The one that had proved the instrument was clean. This time it was named at the highest confidence anywhere in the run, which was still only 0.28 on a scale where 1 means certain. The model's best answer in the whole test was a shrug. And this time, it called the next 3 months exactly right. Same chart, same model family. The only thing we added was 4 dull facts, and not one of them names a company. Correct name plus correct remembered future. That is not a model reading a chart. That is a model remembering a stock. And this is a second sealed envelope written before the pack was ever shown. We had named Chart 7 in it in advance as the case that would decide this, not after we saw the result, before. 2 honesties about that result, and both of them matter. The first, 3 out of 9 is a small count. Run this same 9-chart test 100 times with a model that knew nothing, and about 7 of those runs would still score 3 or better. The second, and this is the one that carries the finding, the claim here is not that the model looks an answer up. A shrug is not a lookup, it is narrower and stranger. It does not know which company this is, and it still remembers what happened next. And what reopened that leak was not the count. It was one company named in advance, flipping from wrong to right. Now, the easy ending stops here because catching an AI cheating is a better story than the one the data actually supports. But look again at who was in that exam room. 9 companies chosen specifically because they are famous. We picked the most recognizable names we could find, on purpose, to make the test as hard to pass as possible. That is the right way to certify an instrument. It is the wrong way to describe the job. Because the job this pack was built for is grading a few hundred ordinary candidates, mid-sized names you would not pick out of a lineup, we had measured the leak on a group the tool would never actually see. So we ran it a third time, with the same 4 dull facts, word for word. This time we drew 12 ordinary names, picked by a fixed random seed, the same shuffle every time, so we could not redraw until we liked the list. And we locked that list before a single chart was drawn. 0 out of 12. It did not name a single one of the ordinary names. And there was a second result, which is the one that convinced me. It could not date them either. 0 out of 12 on the year. Both leaks closed at once, the who and the when. The famous name tell. Every guess it made was a plausible neighbor. Right neighborhood, wrong name, 12 times running. Two caveats on that, and both are limits on us rather than on the model. The first, those two groups differ in more than fame. The famous 9 were hand-picked to be recognizable, the ordinary 12 were drawn at random. So fame is our label for the contrast. It is not a variable we isolated. The second, we cannot tell you which of the 4 facts does the leaking because we tested the pack once as a whole on purpose. Testing it repeatedly until it passed would have been us grading our own paper. What we measured, exactly, is this. The leak does not reach a random draw from the population the tool actually works on. That is narrower than saying fame causes it, and it is the sentence the data supports. So, that is question 3, answered. On a famous name, some of what looks like reading is remembering, and we can now say where the remembering stops. So, back to the wager we sealed before any of this ran. Test 1 asked whether its picking beat the lucky random draw. That one failed in both generations. Test 2 asked whether choosing beats not choosing. That one passed in both generations. Test 3 asked whether it beat a drifting market. That one failed in both generations. 2 generations of the machine, 1 Legends playbook, and the verdict did not move. So question 1 and question 2 are no longer provisional. Its picking does not clear the bar, and a year of progress did not change that. It moved the numbers that flatter, while the number that counts went down 9.2%. And the root cause is boring, which is usually the sign that it is real. The doctrine we handed over is an intraday read. Its capitulation call is made on the live tape. The speed of it, the size coming in, the moment it breaks. Remember what we handed it. 1 row per day. Where it opened, its highest price, its lowest, its closing price, and how much changed hands. 5 numbers for 6.5 hours of trading. We did not hand it his judgment. We handed it a photograph of the day his judgment happened in. And his own course says so. Module 3, Video 2. In his words, the psychological and experiential edge is the part that can't so easily be programmed into an algorithm. So here is the honest shape of that gap. The part of his edge that lives in the rules, we transferred, all 1,000 lines of it. The part that lives in his eyes on a live tape, we never handed over at all. His call is made inside the day, while it is happening. We gave the machine days that had already closed, and the price it opened at. And that is where the open question sits now. If there is edge left in this doctrine, it is in the part that did not travel. We did not test whether a machine could learn that part. We could not on daily bars, so we are not going to tell you it cannot. What we can tell you is that the part being sold to you, the written rules, is exactly the part we did transfer, and it did not pick. We ran a 3-month experiment to confirm a sentence the man had already published. He was right, and he told us first. And if we misread him anywhere in those 121 videos, that is our error, not his. Now, one more, because it is a real hole, and I would rather you heard it from us. That second exam, the new generation, we never reran the cheating check on it. The setups in that exam are older than the new model's training data. So the new model could, in principle, have sat that exam with the answers already in its pocket, and we never verified that it hadn't. Here is why the verdict survives anyway, and it is worth understanding because it is a general tool. Cheating can only make a score better. Our score failed. So whatever the true, uncheated result is, it is worse than the one we published, and the conclusion holds from below. But that arrow cuts at our survivor too. The refusals passed on that uncertified run. So the one thing we are keeping is the one thing this hole could have inflated. What saves it is that it also passed on the generation we did certify. And flip it round. If that exam had passed, we would have had no way to tell capability from recall, and the result would have been worthless. We were saved by which way the answer fell, not by the design. That check is now a fixed step in the procedure, and it should have been one already. So, exactly what is being claimed? Measured, both exam results, and every identification score in this episode. Inferred, not measured, which of those 4 dull facts is doing the leaking. And here is what we will not assert at all, that an AI cannot learn to select. 2 data points is not a trend. What we have is 1 instrument, 1 doctrine, 1 bar per day, and 20 trades. So, what survives all of this, and what should you take out of it? The veto survives. A rules engine fires whenever its conditions match. It cannot decline on a judgment call, because unclear is not a number. This machine could, and its declines were worth money in both generations. That is a real capability we cannot yet size, and it is not the one anybody is selling. The open book problem survives, and it is the portable one. If you ever see a video where an AI picks stocks, ask the one question almost nobody asks. Did anyone check whether it already knew the answer? And the famous name tell survives, with its limit attached. On a random draw from ordinary names, the leak did not reach at all. Ask a model about a household name, and you may be querying its memory. Ask it about a mid-cap you have never heard of, and you are much closer to asking it to actually look. One layer of the stack closed, not the whole question, and the layer his edge actually lives in is the one we could not reach. And here is what would change our mind, which is a live bet, not a caveat. More trades. 20 is the reason we cannot separate its picking from luck, and a clean sample means setups that happened after the model's training data ends, so we counted what is in that window. 65 setups. This machine takes about 1 in 5, so that is roughly 14 trades. We currently have 20. 14. The only sample we can fully trust is smaller than the one we already have. So I wanted to end this by telling you when we run it again. I worked it out, and I was wrong, and the way I was wrong is the interesting part. These setups do not arrive at a steady rate. 45 of them landed in May, 17 in June, 3 in July. Average those, and you get a tidy number, and the tidy number is fiction. It is an average of a burst and a drought, and it describes neither. So we are not going to give you a date. We will run it again when the clean setups exist, and not before, and that is the honest version of a promise we would rather have made specific. No money was risked here. And a capability we could not demonstrate in a machine is not a capability you should put money behind. None of this is a mark against the trader. We handed the machine his notes and a photograph of the market, and asked it to do the thing he does with his eyes on a live tape. It could not from what we were able to give it. His course said, this part does not program easily. It does not. He was the most reliable witness in the room. But the next time your feed serves you a machine that picked a winner, you now own the question that video did not ask. Was it reading the chart, or had it already seen the paper? That is the audit. This is ground truth. The machine is always hungry.